What if I told you that the most profitable quarter in the history of, one of the world's most scrutinized companies was basically an illusion?
Right. A complete mirage.
Yeah, a staggering $10 billion in net income. Just proof. We are talking about an accounting trick that's masking a trillion-dollar empire, an empire whose actual revenue growth just hit exactly 0%.
I mean, it sounds like the setup for some massive corporate scandal, right?
Oh, totally.
But in reality, it is just another Tuesday in the incredibly complex, often misunderstood financial machinery of Berkshire Hathaway.
Welcome to today's deep dive. We really have a fascinating mission for you today. We are pulling from a massive stack of institutional research, financial filings, and alongside all of that, something truly cutting edge.
Yeah, this part's really cool.
It's an AI-generated multi-agent report from Deep Value Intelligence. And the subject today is the most famous compounding machine in the history of capitalism. The ticker is BRKB.
And if you are holding this stock or even thinking about buying it, the ground underneath your feet is shifting literally as we speak.
It really is. And we need to set the scene for you right now because this historical context of this specific moment, it's everything.
Exactly. Today is May 2nd, 2026.
The event known as the Woodstock of capitalism.
Right, the annual Berkshire shareholder meeting. It is happening right now in Omaha, Nebraska. But the atmosphere inside that arena is profoundly different from any of the dozens of meetings that preceded it.
Because this is the very first meeting where Warren Buffett, who is now 95 years old and sitting in the role of chairman emeritus, is not the CEO.
Yeah, that is a huge milestone.
He has officially handed the operational reins to 63-year-old Greg Abel. I mean, we've talked about this transition in theory for years, but now the theoretical has become reality.
The oracle is stepping back.
He really is.
And that changes the entire psychological calculus for the market. For decades, investors flocked to Omaha and poured money into the stock, not just for the underlying financials.
Right, they were buying the man.
Exactly. They were buying a partnership with the greatest capital allocator of the 20th century. Now they are being asked to trust the system he built, rather than the man himself.
It's kind of like, well, think of it like watching your favorite Michelin star restaurant get handed over to the sous chef.
That's a good way to put it.
The recipes are the same, the ingredients in the pantry are exactly the same, the bank account is overflowing, but everyone sitting in the dining room is just anxiously waiting to see if the food still tastes like magic.
Right. But the difference here is we aren't just tasting the food. We are wondering if the new chef knows how to negotiate the lease on the building when the landlord tries to double the rent.
Oh, absolutely. Or how to buy out the supplier when there's a global shortage of truffles. Berkshire isn't just a recipe, It's a dynamic capital allocation machine.
That is a crucial distinction. The sous chef analogy only works if the sous chef is also acting as a global macroeconomist.
Which is a tall order for anybody.
It really is. So the core question we have to answer today, using all these sources, is whether this $1.02 trillion giant can still beat the broad market without its legendary founder at the helm.
Or has Berkshire simply become an American economic ETF that has just grown too big to actually grow?
Right. And let's start right where the market is looking, which is the immediate news.
Yeah. How is the company doing right now, today, as Greg Abel officially takes the driver's seat? We have the Q1 2026 snapshot right in front of us.
And the headline numbers look like an absolute victory lap.
They really do. I mean, if you merely skim the headlines coming out of the first quarter of 2026, you would assume the transition is flawless.
They reported a net income surge to $10.1 billion for the quarter. To put that in human terms, that is $7,027 of profit per Class A equivalent share.
More than double the $4.6 billion they recorded in the exact same quarter last year.
Right, Q1 of 2025.
So on paper, profits just jumped over 100%. But we started this deep dive by calling that number an illusion.
We did.
I want to spend some real time on this because taking headline numbers at face value is exactly how everyday investors get slaughtered.
Oh, entirely.
So unpack the mechanism behind this $10 billion for us. How does a company the size of a nation-state double its net income without some sort of fundamental breakthrough in its business?
Well, it basically comes down to a fundamental change in generally accepted accounting principles.
GAAP accounting.
Right, GAAP. This rule went into effect several years ago. Specifically, it involves a rule created by the Financial Accounting Standards Board that forces companies to include unrealized gains and losses from their equity investment portfolio.
In their bottom line net income.
Yes, exactly, in their bottom line net income.
So if they own, say, 5% of Apple and Apple's stock price jumps in February, Berkshire has to report that paper gain as actual income for the quarter, even if they didn't touch the sell button.
Yes. It is entirely paper wealth.
Oh.
If the S&P 500 has a great quarter, Berkshire's net income skyrockets into the stratosphere.
But they didn't actually make any new money.
Nope. And if the market has a terrible quarter, Berkshire will report massive, multi-billion-dollar losses.
Wow.
Buffett himself actually spent years warning shareholders about this in his annual letters. He called these swings wild and capricious because they completely obscure how the actual underlying businesses are performing.
Right. The railroads, the energy grid, the insurance operations.
Exactly. It basically turns their quarterly earnings report into a mirror of the stock market rather than a mirror of their corporate operations.
So it's pure accounting noise.
Yes, 100%. You as an investor have to mentally strip that away. If you are buying Berkshire Hathaway for its operating prowess, you cannot look at net income. You have to look at operating earnings and revenue.
Okay, so let's do exactly that. Let's strip away the noise of the stock market bouncing around. Let's look at the real operating metrics from the AI report and the 2025 trailing 12 months data.
Let's do it.
When we look at the actual businesses selling real things to real people, what is the underlying financial health?
Well, the picture becomes vastly more sobering. When we look at the total revenue, the actual cash coming in the door from selling insurance premiums, moving freight across the country, generating electricity, selling Dairy Queen blizzards,
Right, the real stuff.
the scale is still colossal. Total trailing revenue sits at $371.44 billion.
$371 billion.
But here is the critical flashing red data point from the institutional research. The year-over-year revenue growth on that $371 billion is flat.
Wait, like completely flat.
It is 0.0%.
Zero. They didn't grow the top line by a single percentage point.
Not one. The revenue engine has stalled, and we really need to look even further down the statement to free cash flow.
Okay, remind everyone what that is exactly.
Free cash flow is the actual hard cash the business generates after paying for all its operations, paying its employees, and making the necessary capital expenditures to keep the lights on and the trains running.
The money they can actually put in their pocket.
Right. That free cash flow number sits at $25.04 billion.
$25 billion sounds like a mountain of money. I mean, most Fortune 500 companies would kill for a fraction of that.
It is a massive nominal number, but, investing is about relativity. This is a company valued by the market at over $1 trillion.
Right.
So when you divide that $25.04 billion in free cash flow by the $1.02 trillion market capitalization, you get a free cash flow yield of about 2.5%.
Let's pause and think about what that means for someone listening right now. If the revenue growth is literally 0% and their free cash flow yield is 2.5%, you are getting a yield that basically matches a standard savings account.
Or even underperforms a short-term treasury bill right now.
Yeah, exactly. If I can get 4% risk-free from the government, why is the market valuing Berkshire at over $1 trillion with a 2.5% yield? I mean, why are people paying a premium for zero growth?
That tension is the central puzzle of Berkshire Hathaway in 2026. To understand why the market tolerates that, we have to look completely under the hood.
Break it down for us.
We have to dissect the architecture of what is essentially a $1 trillion moat. The market isn't paying for explosive tech-like growth. They know they aren't buying the next NVIDIA.
Right. They aren't buying AI chips.
Exactly. They are paying for an infrastructure of safety, capital generation, and structural advantages that frankly cannot be replicated by any other corporation on Earth.
I want to break down that revenue piece by piece because I think a lot of people hear Berkshire Hathaway and they just think Warren Buffett, stock picker.
Yeah, that's a very common misconception.
They think it's a giant, glorified mutual fund that happens to be publicly traded. But stock picking is just the tip of the iceberg, isn't it?
Stock picking is merely the exhaust valve for the cash engine. The true engine is an industrial and commercial powerhouse.
Okay, so where's the money actually coming from?
The institutional report provides a really granular breakdown of that $371 billion in revenue. The biggest chunk, accounting for 46.2% of total revenue, comes from a segment called Manufacturing, Service, and Retailing, or MSR.
And that's how much in dollars?
This alone brings in $171.64 billion.
Let's give the listener some tangible examples of what lives inside that MSR segment. What are we actually talking about when we say manufacturing, service, and retailing?
We are talking about the physical, tangible backbone of the economy. We're talking about companies like Precision Castparts, which manufactures complex metal components, forgings, and castings for the aerospace industry.
So really heavy industrial stuff.
Yeah, if you fly in a commercial jet, you are likely relying on parts forged by a Berkshire company. We're also talking about Marmon, a massive conglomerate in its own right that does industrial leasing, making rail tank cars and intermodal tank containers. We're talking about Iskar in metalworking.
So heavy industry, heavy capital expenditure businesses.
Plus the consumer brands you see every day.
Like what?
Fruit of the Loom underwear, Duracell batteries, Benjamin Moore paints, Brooks running shoes, and of course, Dairy Queen.
It's an incredibly diverse basket.
It really is. If the aerospace industry slows down, maybe the retail paint division is booming because of a housing remodel surge. It creates steady, unshakable, predictable cash flow.
And that covers almost half the revenue. What's the next pillar?
The next biggest piece is the insurance operations. This brings in $96 billion, representing 25.8% of revenue.
Wow, okay.
This segment is the crown jewel. It includes Geico, which alone holds somewhere between 16 and 17 million active auto insurance policies.
That is a lot of drivers.
And it includes their massive reinsurance operations, historically led by Ajit Jain, which insures other insurance companies against catastrophic risks like hurricanes or earthquakes.
We are going to dig deeply into the insurance side in a minute because that is where the real financial magic happens. But let's round out the revenue picture first.
Sure. So beyond MSR and insurance, you have the McLean Company. This is a massive wholesale supply chain business.
Who do they supply?
They deliver groceries, non-food items, and beverages to convenience stores, discount retailers, and chain restaurants all across America. That brings in $53 billion, or 14.3% of revenue.
Okay, so that's a huge logistical operation.
And finally, you have the utilities and infrastructure. Berkshire Hathaway Energy, or BHE, and the BNSF Railroad. BHE provides about 7.2% of revenue, coming in at $26.9 billion.
Paint, underwear, auto insurance, wholesale groceries, rail cars, and power plants.
Yeah, quite the mix.
It is the most brilliantly boring portfolio of companies imaginable. But the magic isn't just that they own these businesses, it's how they finance them.
Exactly.
This brings us to what I consider the most important concept in the entire Berkshire Hathaway playbook. A concept that every investor needs to understand. Float.
Float is the Rosetta Stone of Berkshire Hathaway. If you understand float, you understand why Berkshire became a trillion-dollar company.
I hear this word thrown around all the time in finance discussions. People use it like a buzzword. But let's really break down the mechanics for the listener. What exactly is insurance float? And why is it considered the ultimate competitive advantage?
Let's use your own life as an example. Think about how you pay for your auto insurance. You pay your premium to an insurer like Geico up front, correct?
Yeah.
You might pay for 6 months or a year of coverage in advance.
Right. I pay it, it hurts to look at the bill, and then I hope I never actually get into an accident and have to use it.
Now multiply your premium by 16 million customers. Geico is collecting a mountain of cash every single day. That money legally belongs to the policyholders in the sense that it exists to pay their claims.
Right. It's not truly Geico's money to just blow.
Right. But Geico gets to physically hold that cash until and if those customers get into a car crash and file a claim. That pool of money, the massive reservoir of cash held between receiving premiums and paying out claims, is called the float.
And how big is that reservoir right now?
According to the AI report, as of March 2026, Berkshire holds $176.9 billion in float.
Over $176 billion. Just sitting there, legally held by Berkshire, waiting to be used.
Here is where the mechanism becomes a superpower. In a normal corporate environment, if a CEO wants to go buy a new factory or acquire a railroad or buy $100 billion worth of Abel stock, they have to raise capital.
Right, they can't just conjure it out of thin air.
They either issue new stock, which dilutes existing shareholders, or they go to a bank or the bond market and borrow money. When you borrow money, you have to pay interest.
And that interest rate is your cost of capital.
Exactly. It acts as a hurdle. An investment has to earn more than the interest rate to actually be profitable.
But Berkshire doesn't have to go to Wall Street banks to borrow money to buy companies.
No, they use the float, but it gets even better. Because Berkshire's insurance operations are historically so well managed, they generally operate at an underwriting profit.
Meaning what exactly?
Right. That means the premium money they collect from you and everyone else is actually greater than the money they eventually pay out in claims and operating expenses.
Wait, so they are essentially being paid by their own customers to hold on to this $176 billion.
You've hit the nail on the head. For most companies, debt is a burden. It costs them 5, 6, 7% a year in interest. For Berkshire Hathaway, Their debt, the float, is negative cost capital.
That is insane to think about.
They have a $176 billion revolving credit facility that actually pays them a yield to use it. No other non-insurance conglomerate in the world has access to this kind of structural advantage.
So they basically have infinite financial flexibility.
It allows them to fund massive acquisitions and equity investments without relying on fragile market debt.
So we have this giant industrial, retail, and utility engine, and it is entirely fueled by a completely free $176 billion credit card provided by millions of insurance customers.
Right.
That explains the safety infrastructure, and it results in what the Deep Value AI report calls a fortress balance sheet.
The financial health metrics in this report are almost comical compared to standard corporate America.
Give me some numbers.
Their debt-to-equity ratio is exactly 0.000.
I want to repeat that for the listener. $1 trillion industrial conglomerate with a debt-to-equity ratio of 0.
Their net debt is actually negative $52.57 billion, simply because their cash reserves dwarf their liabilities.
Incredible.
And look at their interest coverage ratio. That measures how many times over a company can pay its minor operational interest expenses from its operating profits. A healthy company might have a ratio of 4 or 5. Berkshire's is 16.27.
They could pay it 16 times over.
And then there is the ultimate metric of their fortress, the number that gives Greg Abel total optionality. They are sitting on a staggering $397.4 billion in cash and short-term equivalents.
Almost $400 billion in pure, unadulterated cash. Which brings us right into the central tension of this deep dive.
Here we go.
If the machine is so robust, if they have zero debt, if they are armed with negative cost capital, and they have nearly $400 billion in the bank, why is the Deep Value Intelligence report throwing up red flags? Why are we questioning the future?
Because of gravity. Financial gravity. The very size that makes them safe is the size that makes future outperformance incredibly difficult. We are transitioning into the biggest permanent risk facing Greg Abel right now, the scale curse.
The scale curse. It sounds pretty ominous.
Just mathematical reality. There is a brutal reality check outlined in the Deep Value report called the tenfold test.
Walk us through that.
When you evaluate traditional growth stock, the mental exercise is to ask, could this company eventually 10x its revenue and market cap? For a nimble software startup, the answer might reasonably be yes.
Right.
But for Berkshire, the math breaks down under its own weight.
Let's run that math.
Currently, Berkshire is valued at $1.02 trillion, generating roughly $370 billion in annual revenue. If Berkshire were to deliver a 10x return from here through pure fundamental growth, they would need to generate between $3.6 trillion and $4.0 trillion in annual revenue.
$4 trillion in revenue. That isn't a company anymore. That's a sovereign nation.
Well, put it in perspective, Germany's entire gross domestic product is around $4 trillion. Japan's GDP is around $4.2 trillion.
That really puts it in perspective.
For Berkshire to 10x its revenue, it would practically have to consume a monopolistic, antitrust-shattering percentage of the global economy. It is mathematically impossible. The law of large numbers dictates that a tree cannot grow to the sky.
You just can't compound at 20% a year when your baseline is $1 trillion. You just run out of things to buy.
Exactly. And this leads to a prevailing viewpoint held by many institutional analysts today. Berkshire has essentially transformed into an American economic ETF.
Explain the implications of that for a retail investor. If I buy an S&P 500 ETF, I'm just buying the market. Are you saying buying Berkshire is functionally the same thing now?
In terms of growth trajectory, yes. You are no longer buying a nimble vehicle that will vastly outpace the U.S. economy.
Because they literally are the economy.
Think about what they own. They own the rails that move the freight across the continent. They own the power lines that move the electricity to the homes. They own the insurance that covers the cars commuting to work.
It's ubiquitous.
Their growth is tethered directly to the underlying heartbeat of U.S. GDP growth. If America grows at 2%, Berkshire's intrinsic operations will likely grow at a similar steady pace.
And we can actually see that compression in the returns on capital, right?
Absolutely. The 10-year financial history in the AI report shows this clearly. The return on equity, or ROE, has compressed down to 9.3%.
Let's pause. ROE is return on equity. For someone who doesn't stare at balance sheets all day, what does a 9.3% ROE actually mean in the physical world of this business?
Well, return on equity measures how effectively management is using the shareholders' capital to generate profit. If you give a company $100 and they generate $9.30 in profit with it over a year, that's a 9.3% ROE.
Okay, that makes sense.
Now, 9.3% is a steady, respectable number. It is well above their cost of capital, so they are creating value, but it is not explosive.
Right.
The return on invested capital, or ROIC, which factors in debt, is sitting at 10.6%. Again, solid but not spectacular. You are not seeing the 25 or 30% returns on capital that a fast-growing, capital-light tech monopoly generates.
So if they can't double or triple in size anymore, if the ROE is single digits, if the top-line revenue growth is literally zero right now, are we just buying a really safe, low-yield bond disguised as a stock? I mean, what is the actual value proposition for buying BRKB today under Greg Abel?
That is the trillion-dollar question that the AI report wrestles with, and it leads directly into the most contentious part of the analysis, the valuation disconnect.
Okay, this is where it gets spicy.
If growth is fundamentally capped by the laws of mathematics, then the entire investment thesis rests on one single variable. What is the correct intrinsic price to pay for this asset today?
And according to the Deep Value AI screeners, a lot of traditional value metrics, the very metrics Warren Buffett popularized, are flashing warning signs right now.
They are. The AI ran Berkshire's current financials through standard, strict, deep value constraints, and the stock actually fails several of them.
Let's go through.
For instance, strict deep value investors generally look for a price to earnings, or PE ratio, of under 15. That means you're paying less than 15 times the company's annual earnings to own the stock.
And where's Berkshire?
Berkshire's trailing 12-month PE currently sits at 15.16, so it is slightly over the value line.
Okay, a PE of 15.16 isn't nosebleed territory, but it's a minor fail on a strict value screen. What else?
The AI also looks at the price earnings to growth ratio, the PEG ratio. The rule of thumb in value investing is to look for a PEG ratio of under 1.
Wait, before we throw the number out there, what exactly is the PEG ratio measuring that a standard PE doesn't? Why do we need another ratio?
Well, a standard PE ratio tells you how much you are paying for past earnings, but it tells you nothing about the future. The PEG ratio takes the PE and divides it by the company's expected earnings growth rate.
So it brings growth into the equation.
Exactly. It penalizes you for paying a high multiple for a slow-growing company. If a company has a PE of 20 but is growing at 20% a year, the PEG is 1. That's considered fair.
Okay, so what is Berkshire's PEG ratio right now?
Berkshire's PEG ratio is a massive 6.54.
6.54. Wow, because the growth is zero.
Precisely. The math is punishing them. That 6.54 reflects the reality that you are paying a decent multiple of 15 times earnings for a company that has practically zero recent operating growth.
That's a terrible PEG ratio.
And then there's the ultimate commandment of Buffett's philosophy, the margin of safety. Deep value investors want to buy $1 for 75 cents. They want a 25% discount to the calculated fair value to protect themselves against being wrong.
And are we getting that discount right now?
Not at all. The current stock price of BRKB in this report is $473. Morningstar estimates the fair value of the business at $510.
So what's the math on that?
That means the stock is only trading at a 7% discount. It fails the 25% margin of safety rule completely. You are paying practically full retail price for this business.
So the surface level metrics say it's expensive, or at the very least, fully priced. But the Deep Value AI report goes way deeper than surface metrics. It runs complex internal math models. I want to walk the listener through this section called the modeling chasm because this part of the report completely blew my mind.
The chasm is wild. It shows how fragile financial modeling can really be. The AI ran two different discounted cash flow, or DCF, models.
What's the DCF model in simple terms?
A DCF model is a way to value a company by estimating all the future cash it will ever generate and mathematically discounting that cash back to its present value today. The AI ran one model based on standard free cash flow and one based on Warren Buffett's proprietary owner earnings concept.
Let's start with the standard free cash flow method. What does traditional Wall Street math say Berkshire is worth?
Using standard free cash flow, the model spits out three scenarios: a conservative value of $111 per share, an average case of $187 per share, and a wildly optimistic case of $348 per share.
Let me stop you right there. The stock is trading in the real world at $473. The most optimistic standard cash flow model says it's only worth $348.
Yeah.
So the model says the stock is massively overvalued.
If you view Berkshire purely as a standard cash-generating business without factoring in the unique compounding potential of its retained earnings, it looks severely overvalued.
Right.
But Warren Buffett has stated for decades that standard free cash flow is a flawed metric for a company like his. He uses and encourages analysts to use what he calls owner earnings.
Let's unpack the mechanism of owner earnings. Why did Buffett invent this metric, and how is it fundamentally different from the free cash flow number we just talked about?
He invented it because GAAP accounting often forces companies to record depreciation charges that just don't match economic reality. And it doesn't clearly separate capital expenditures required to just maintain the business versus capital expenditures used to grow the business.
Okay, that makes sense.
Owner earnings is a truer picture of the cash an owner could actually put in their pocket at the end of the year without degrading the competitive position of the business.
What's the actual formula?
The formula takes reported net income, adds back depreciation and amortization, subtracts necessary maintenance capital expenditures, and adjusts for working capital.
Okay, so it's a refined, more economically realistic version of cash flow. What does the AI calculate Berkshire's owner earnings to be?
The AI calculates Berkshire's owner earnings at roughly $57.16 billion.
That is significantly higher than the $25 billion free cash flow number. So when the AI plugs that $57 billion into the valuation model, what happens?
The valuation explodes into a completely different stratosphere. Using the owner earnings method, the conservative value is $79 per share.
Still terrible.
But the average value jumps to $718 per share. And the optimistic value reaches an astounding $2,639 per share.
This is exactly what I mean by the chasm. The models say the stock is worth somewhere between $79 and $2,600. If the mathematical formulas can't agree whether the stock is worth a fraction of its current price or 5 times its price, isn't this entire valuation exercise just totally subjective?
It appears completely subjective at first glance, but there is a profound logic behind the gap. The chasm between those numbers exists because of one single massive variable sitting on the balance sheet.
The cash.
Exactly, the $397.4 billion cash pile.
Explain how the cash breaks the models.
A standard DCF model looks at the cash a business generates from its operations and discounts it back. It fundamentally assumes that excess cash sitting in a bank account is sterile.
Sterile, like it's just doing nothing.
Right, it's just sitting there earning minimal interest. But the owner earnings model assumes that management is active. It assumes management will take that retained cash and deploy it at historical rates of compounding return.
Ah. So the model is highly sensitive to what management actually does with the money tomorrow, not just what the business produces today.
Yes. If Greg Abel just lets that nearly $400 billion sit in short-term treasury bills forever, or worse, if he gets impatient and makes a terrible, overpriced acquisition that destroys value, then the lower valuations are absolutely right.
The cash is dead weight dragging down the returns.
Precisely.
But if he finds a brilliant way to deploy it,
If Greg Abel finds a way to deploy that capital, say, macroeconomic environment shifts, the market crashes, and he buys incredible cash-flowing assets at fire sale prices, just like Buffett did during the 2008 financial crisis, then the compounding machine roars back to life.
and that's when the math changes.
In that scenario, the $718 valuation, or even higher, becomes the reality. The intrinsic value of Berkshire Hathaway today is entirely dependent on future capital allocation, not just its current operating assets.
So buying Berkshire today at $473 a share is essentially a massive bet on Greg Abel's brain.
It is a bet on his discipline, his patience, and his ability to execute under pressure. The AI report notes that the current 2.5% free cash flow yield means you have very little cash return protection today.
You're flying without a net.
You are paying a premium for the option that management will do something brilliant tomorrow.
Which brings us to the existential risks. Since the entire valuation hinges on the future, and specifically on Greg Abel's future decisions, we have to look at the threats facing his Berkshire. We have to look at what could break the machine.
And the market is already showing its skepticism regarding the transition. Let's look at what analysts call the transition discount.
The report mentions a staggering statistic. Since the succession was officially announced, BRKB has lagged the S&P 500 by 39 percentage points.
That is a massive underperformance relative to the broader market.
It really is.
It is a profound drag. And it reflects the reality that Greg Abel, for all his operational brilliance in running the massive energy division for years, lacks Buffett's historic alpha-generating aura.
Yeah, Buffett could secure deals just by picking up the phone.
Exactly, because a stamp of approval from Warren Buffett was worth billions in market sentiment. The market is basically saying, we trusted Warren to hold $400 billion in cash and wait for the perfect pitch. We don't know if we trust Greg yet.
To be fair to Abel, the report points out that he isn't just sitting still. He is already making significant moves. He is actively trimming their massive equity positions, specifically taking an axe to their holdings in Apple and Bank of America.
That's true.
The report has this great summary. It shows that under Abel, cash is a tool, not a trophy. He's willing to take profits, incur the tax hit, and build liquidity rather than just holding forever for sentiment's sake.
That shows operational independence, which is a good sign. But managing the stock portfolio is only one part of the risk matrix. We have to look at the operating
Oh,
businesses.
right, the real-world assets.
Because they face structural, long-term threats that Buffett never had to deal with in his prime. The first major category of threat is technological obsolescence, and the prime target here is Geico.
Geico represents 16 to 17 million auto policies. As we discussed, it's the engine of the float. What happens to that engine in the age of artificial intelligence?
Well, we have to ask a fundamental question about the total addressable market, or TAM, of auto insurance. Auto insurance pricing is based on human error.
Because humans are terrible drivers.
Exactly. The vast majority of accidents are caused by human mistakes. What happens if autonomous driving, powered by AI, actually fulfills its promise over the next decade?
Oh, wow.
If Waymo or Tesla's full self-driving systems drastically reduce the frequency of car accidents, the TAM for auto insurance will shrink permanently.
Fewer accidents mean lower premiums.
Which means a fundamentally smaller pool of float for Berkshire to invest.
If the float shrinks, the free credit card shrinks. That's a structural decline.
And it's not just Geico facing the AI threat. Look at the BNSF Railroad, which moves a massive percentage of North American freight.
What's the threat there?
The rise of AI-optimized logistics grids, advanced localized manufacturing like 3D printing that reduces the need to ship parts across the country, and the eventual rise of autonomous trucking.
That could completely change how freight moves.
It could slowly erode the traditional moat of rail freight. Berkshire's assets are deeply rooted in the 20th century physical economy. AI threatens to dematerialize parts of that physical economy.
It feels like Berkshire owns the world's most profitable, impenetrable medieval castle. They have the moat, the high walls, the archers. But the risks aren't armies with ladders anymore.
What are they?
It's someone inventing airplanes and flying right over the walls. The world is changing the rules of the physical game.
That is the perfect way to visualize it. The moat is strong against traditional competitors, but vulnerable to paradigm shifts. And the airplanes flying over the walls aren't just technological.
What else is flying over?
They are environmental and legal. This brings us to perhaps the most immediate, terrifying existential threat in the operating portfolio: climate change liabilities at Berkshire Hathaway Energy.
Let's talk about BHE, because historically, regulated utilities used to be the safest, most boring investment in the world. You build a power plant, you string up some wires, the government grants you a regional monopoly and guarantees you a regulated rate of return, and you just sit back and collect the checks.
That era is officially dead.
Yeah.
The landscape of regulated utilities is facing a complete paradigm shift in risk due to an evolving legal concept called inverse condemnation.
I've heard this term in relation to the California wildfires. Break down the mechanism of inverse condemnation for us. How does it threaten Berkshire?
Inverse condemnation is a legal doctrine originally rooted in eminent domain.
The idea that the government can't take your property without compensation.
Right. In certain states, particularly out west, courts have applied this to utilities. The doctrine states that if utility equipment like a BHE power line is found to have been the ignition source for a wildfire, the utility can be held strictly liable for the resulting property damage.
Strictly liable.
And here is the terrifying part. They can be held liable regardless of whether they were actually negligent in their maintenance.
Wait, let me get this straight. Even if BHE maintained the power line perfectly, following every safety regulation to the letter, if a freak 80-mile-per-hour windstorm knocks a healthy tree into that line and starts a fire, the utility pays for the whole town burning down.
Yes, strict liability means fault doesn't matter, causation does. And the institutional report highlights massive, multi-billion-dollar tort liability risks currently facing BHE due to wildfires in the Pacific Northwest.
Any specific cases?
Specifically involving their Pacificor subsidiary, as well as the recent devastating Los Angeles fires in January 2025.
A multi-billion-dollar liability that can spring up overnight from a single spark.
Warren Buffett explicitly warned shareholders about this in his recent letters. He essentially said the historical predictability of the utility model is breaking down.
Because of the weather.
Climate change means more severe weather, more prolonged droughts, and higher winds. Combine that environmental reality with the legal reality of inverse condemnation, and it turns a stable, cash-flowing asset into a massive, unpredictable liability that could theoretically wipe out years of profit in a single afternoon.
So, to summarize the landscape, Greg Abel is taking over. He has a company with zero revenue growth, a $400 billion cash pile that is dragging down his return on equity, the threat of AI shrinking his insurance float, and climate change threatened to bankrupt his power companies with strict liability lawsuits.
It certainly frames the transition discount in a stark light.
So with all these pros and cons laid out on the table, the impregnable fortress balance sheet on one side and these massive structural existential risks on the other, how do we actually make a decision as investors? Should an individual investor buy this stock at $473 or not?
This is where we turn to the most fascinating methodology in the Chinese AI report. The Deep Value Intelligence System doesn't just run static numbers. It uses a multi-agent framework.
Explain what a multi-agent framework is.
It means the system uses large language models to create distinct, specialized AI personas with different investment philosophies. It forces these agents to analyze the data and actively debate each other.
That is wild.
Then, a separate algorithmic persona, called the risk judge, evaluates the arguments and makes the final synthesized call.
It literally argues with itself to find the blind spots. I love this. So who are the debaters in this specific report?
We have the safe analyst, which represents a strict conservative value investor perspective, and we have the risky analyst, which represents an aggressive, opportunistic macro perspective. Let's look at the safe analyst's argument first.
What is the safe analyst seeing in the data?
The safe analyst argues that paying $473 for BRKB right now is a highly dangerous allocation of capital. The agent points to the facts. You are buying a company with 0% revenue growth, a single-digit 9.3% ROE, and unproven capital allocation leadership.
So it's basically saying don't do it.
Right. You are paying a fair price based on Morningstar estimates, which means you have absolutely zero margin of safety. If you buy now, the safe analyst argues, you are locking your money into flat, mediocre, index-lagging returns for a decade. The conclusion is to avoid it completely until the price drops significantly.
That argument is incredibly solid. It relies entirely on the math we just discussed. So what is the risky analyst's counterargument? How do you defend buying a zero-growth company at full price?
The risky analyst focuses on the biggest blind spot of the conservative approach, introducing a concept called the wait penalty.
The wait penalty. What does that mean in practice?
If you sit around in cash waiting for Berkshire stock to drop to a perfect intrinsic valuation of, say, $400 a share, you might be waiting for a train that never arrives. Berkshire is a long slope snowball.
It just keeps rolling.
Even if it is growing slowly, the retained earnings ensure that the intrinsic value marches upward every single year. But more importantly, the risky analyst attacks the safe analyst's view of the $400 billion in cash.
How so?
The safe analyst sees the cash as a drag on ROE. The risky analyst sees the cash as immense option value.
Option value. Meaning what, exactly?
Meaning that Berkshire's greatest value proposition to an investor isn't realized during a bull market. Its greatest value is realized in a crisis. Think back to 2008.
The financial crisis.
When the global financial system was melting down and credit markets froze completely, General Electric and Goldman Sachs were desperate for capital. They couldn't go to the banks.
No one was lending.
They went to Warren Buffett. He gave them billions in exchange for incredibly lucrative preferred stock and warrants. That is called crisis alpha.
So the argument is that when the next macro black swan hits, whether it's a massive liquidity crunch, a geopolitical shock, or another pandemic, every other company will be struggling just to survive.
And Berkshire will be the only entity on the planet with $400 billion in cash.
Ready to act as the lender of last resort and buy the dip at generational valuations.
That is the core of the risky analyst's thesis. You aren't paying $473 for what they are doing today. You are paying for the right to be partnered with their balance sheet when the world ends.
That's a powerful way to look at it.
If you stubbornly wait for the stock to drop to a value screener's discount, you might miss the moment the machine actually fires its weapons.
So we have a total standoff between the agents. The safe analyst says it's too expensive, too slow, and lacks leadership certainty. The risky analyst says if you wait for a discount, you miss the crisis alpha and the unstoppable march of book value. How does the AI risk judge break the tie? What is the middle ground?
The AI risk judge synthesized both of these arguments, weighing the macro risks against the balance sheet strength, and gave Berkshire Hathaway a final score of 3.21 out of 5.
Okay, so right down the middle.
The official stance of the AI system is Wat-CH or Guanwang in the original Chinese report.
Watch. So the multi-agent supercomputer's advice is basically to do nothing.
Not exactly. Watch in this context is a highly active state. The AI provides a very specific, actionable strategy for navigating this. It advocates for a methodology called cautious fractional accumulation.
Let's translate that for the listener. What should someone actually do with their brokerage account tomorrow morning based on this strategy?
It means you have to abandon the retail investor's instinct for black and white thinking. It's not about going all in or having zero exposure. If you already hold BRKB in your portfolio, hold tight.
Don't panic, Sal.
Right. The downside risk of permanent capital loss is near zero. The fortress will hold against inflation and market shocks.
And if I'm a new buyer looking to initiate a position?
The strategy says don't go all in at the current price of $473. It is fully valued, and you are taking on the transition risk without a discount. But conversely, don't rigidly anchor to a fantasy price like $400 because the underlying value of the company grows a little bit every day.
So what's the move?
Instead, look for technical support levels on the chart. The report identifies $466 and $460 as strong historical support zones.
So if the market has a bad week, the Fed says something hawkish, and the stock dips to 465.
That is when you strike, but you strike small. You slowly build a defensive base. You buy a fraction of your desired total position. You use Berkshire Hathaway to lower the overall volatility of your portfolio, acting as an anchor.
That makes a lot of sense.
But, and this is the key, you save the bulk of your dry powder, your own cash, for when the broader market eventually panics. You buy the fortress slowly when it's slightly on sale, so you can ride alongside them when the next crisis hits.
That is a masterclass in portfolio construction. Let's wrap this up, because we have covered a massive amount of ground today. We started by looking at the $10 billion net income illusion, breaking down how GAAP accounting distorts the reality of a company with 0% revenue growth.
Yeah, that was eye-opening.
We explored the magic of that $176 billion negative cost insurance float and how it fuels the diverse MSR segment. We tackled the mathematical reality of the scale curse limiting their upside and dug into the massive valuation chasm between free cash flow and owner earnings,
Proving that the value of Berkshire today is entirely dependent on how Greg Abel deploys $400 billion in cash.
And finally, we weighed the existential threats of AI insurance disruption and climate change lawsuits against the unparalleled crisis alpha option value of the balance sheet. Ultimately, Berkshire Hathaway is shifting from a high-growth compounding machine into a highly defensive, cash-rich economic fortress. It is a watch, but it's a highly strategic, calculated watch. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer, all analysis is based on publicly available forces and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
As you digest everything we discussed today, I want to leave you with one final, lingering question to ponder on your own. We've talked extensively about the law of large numbers limiting Berkshire's traditional growth. But consider this alternative future.
I'm listening.
As passive indexing takes over the world and fewer institutions do fundamental bottom-up stock picking, does a mountain of actively managed patient capital actually become more valuable? If market volatility increases over the next decade due to blind algorithmic trading and high-frequency momentum shifts, Berkshire's $400 billion cash pile might not just be a defensive safety net, it might become the ultimate offensive weapon.
Something to think about while we wait for the next crisis. Thanks for joining us on The Deep Dive.